Hi, my name is Hank, your host at Global Finance Mindset. Welcome to Part 2 from The Invisible Hand. Let's start. Chapter 6, The Architecture of Paper Bitcoin. But here is where this story transcends lawsuits and regulatory battles and becomes something that affects every person listening right now. Because the deepest threat is not what Jane Street may or may not have done. The deepest threat is the system itself. Caitlin Long spent 22 years on Wall Street and left because she could see where it was headed. In 2016, years before Bitcoin ETFs were even a serious discussion, she published a warning. When institutional finance arrives in Bitcoin, it will be a double-edged sword. The new demand will push prices higher, but the derivatives, the paper instruments, the structured products will follow, and they will bring suppression. The mechanism is something called rehypothecation. It works like this. You deposit Bitcoin as collateral for a loan. The institution that receives your Bitcoin can use it as collateral for their own borrowing. That borrowing gets used as collateral again. One real Bitcoin, sitting in a vault somewhere, backs 3 or 4 or 10 separate financial claims. Each of those claims trades in the market as if it were Bitcoin. The supply of real Bitcoin is fixed at 21 million coins. The supply of financial instruments representing Bitcoin is not fixed at all. It is limited only by the appetite of institutions to create them. When synthetic supply grows, when ETFs, futures, options, yield products, and leveraged instruments multiply the effective number of Bitcoin claims trading in the market, the basic economics of supply and demand respond. More supply, all else equal, means lower prices. Not because anyone sold a single Satoshi, not because a single real coin changed hands, simply because paper instruments manufactured by financial institutions increased the apparent supply of Bitcoin in the marketplace. Long estimates the ratio of paper claims to actual physical gold in the gold market reached approximately 100 to 1 at its worst. 100 paper claims for every real ounce of gold in existence. The price of gold, she argues, was suppressed for decades precisely because of this dynamic. The paper market inflated supply, deflated price, and prevented gold from reflecting its true scarcity value. She sees the same architecture being built around Bitcoin, brick by brick, product by product, ETF by ETF. And she is not alone in this analysis. Michael Saylor, the most prominent Bitcoin investor in the corporate world, the man who turned MicroStrategy into a Bitcoin treasury company, describes the mechanism plainly. When you post Bitcoin as collateral and the recipient rehypothecates it, lends it again and again, $10 million of Bitcoin can generate $30 or $40 million of selling pressure in the market. The same coins, counted multiple times, each count contributing to downward pressure on the price. Most people who think they own Bitcoin may actually own a derivative of a claim on Bitcoin. And when the music stops, when settlement actually matters, there may not be enough chairs. Chapter 7. The Gold Trap, and Why Bitcoin is Different. The gold bugs were right. For decades, analysts who argued that the gold market was manipulated through paper instruments were dismissed as conspiracy theorists. They pointed to patterns, to anomalies, to regulators who looked the other way. They were mocked. They were marginalized. Then, one by one, the evidence accumulated. Banks paid billions in fines for precious metals manipulation. Traders were convicted. The mechanisms the gold bugs had described turned out to be largely accurate. Gold's price was, for an extended period, significantly suppressed below what pure supply-demand fundamentals would have implied. And gold never recovered its natural price discovery. Because gold cannot escape. You cannot email a gold bar. You cannot send it over a radio signal. Physical settlement is slow, expensive, and controlled by the same institutions that benefit from the paper system. The gold market became permanently financialized, and small investors holding paper gold are still today holding claims rather than metal. Bitcoin is different. This is not a marketing claim. It is a structural fact. Bitcoin settles in 10 minutes between any two people on Earth without requiring permission from any institution. You do not need a bank. You do not need a broker. You do not need a clearinghouse. You need a private key and a network connection. And the network connection need not even be the internet. Bitcoin transactions have been transmitted over amateur radio, over mesh networks, over satellite links, over systems entirely outside the control of any government or financial institution. Wall Street can trade representations of Bitcoin. They can short it, wrap it in ETF packaging, financialize it through derivatives, create synthetic supply through structured products. They can do all of this, and they cannot alter a single line of Bitcoin's code. They cannot increase the supply above 21 million coins. They cannot prevent two people with private keys from transacting directly, peer-to-peer, outside every institutional channel entirely. Long-term holder data supports this picture. Even through the most aggressive selling of late 2024 and 2025, approximately 70% of all Bitcoin remained in the hands of long-term holders who did not sell. These are not institutions. These are individuals who understand the game being played and have chosen to remove their chips from the table entirely by holding keys in cold storage. The paper market can distort the price. It cannot capture the asset. Chapter 8. Two Truths in Conflict. The Bitcoin community fractured into two camps when the Jane Street story erupted, and both camps have legitimate points, which tells us something important about the complexity of what is happening. Camp 1 says this is systematic manipulation, the same playbook Wall Street ran on gold for decades, now being executed on Bitcoin. Crash the price, liquidate leveraged retail, accumulate at a discount, repeat until the asset is financialized beyond recognition, and institutions own both the asset and the derivatives structured on top of it. Camp 2 points to on-chain data that is difficult to argue with. Blockchain analytics from Q4 2025 show that dormant Bitcoin, coins that hadn't moved in 3, 5, even 7 or more years, began flowing to exchanges in record quantities. These were not algorithmic liquidations. These were original Bitcoin holders, people who had accumulated during the earliest years, distributing into the strength of a price that had touched $125,000. This was cycle mechanics, not manipulation. Long-term holders sold the top to short-term buyers who were riding leverage into a parabolic move. The price corrected as it always has when that dynamic reaches its extreme. Here is the uncomfortable synthesis. Both are true, simultaneously. The organic selling was real. Long-term holders did distribute. The correction had fundamental justification. And into that correction, into the selling pressure that already existed, a market structure saturated with synthetic supply, rehypothecated claims, and derivatives exposure amplified every move downward. The natural drawdown became deeper than it might otherwise have been. The recovery was slower. The liquidation cascades were wider. Jane Street did not cause the correction. The paper machinery did not create selling pressure from nothing. But it may have acted as an amplifier, turning a 5 in the market's volume into a 10, transforming a natural cycle into something that felt engineered and inexplicable to the millions of retail investors caught in the middle. The manipulation, if it exists, does not create the storm. It ensures the storm is far worse than nature intended. Chapter 9. The real question. By now you may be asking yourself, why does any of this matter to me? It matters because of where it is heading. Bitcoin is no longer a fringe asset held by early adopters and cypherpunks. It is an asset held inside pension funds, sovereign wealth funds, corporate treasuries, ETFs owned by millions of ordinary Americans who wanted exposure to the best-performing asset of the last decade. The financialization of Bitcoin is not a future possibility. It is happening right now. And with that financialization comes every tool, every strategy, every instrument that traditional finance has spent centuries perfecting, including instruments designed to profit from volatility rather than simply ride it, including structures that multiply selling pressure, including authorized participants who operate at the infrastructure level of the market with privileges no ordinary investor possesses. The lawsuits will play out in court. The regulatory battles will continue across multiple jurisdictions. Jane Street has denied wrongdoing and will have its opportunity to respond to each allegation. Facts will emerge. Courts will rule. That process exists for a reason, and we should respect it. But the structural questions, the ones about what it means to own Bitcoin through an ETF, about what rehypothecation does to price discovery, about what happens when settlement is demanded and the paper stack collapses. Those questions exist regardless of any specific lawsuit's outcome. They are not about Jane Street. They are about the architecture of the financial system itself. And that architecture has a long, documented history of pricing assets below their true scarcity value when paper supply overwhelms real supply. It happened to gold. It is happening, arguably, to Bitcoin. The question is not whether the mechanism exists. It does. The question is how deep it goes, and what happens when it reverses. Chapter 10. The Escape Valve. Here is what makes this story ultimately more than just a tale of institutional predation. Bitcoin has something gold never had: an exit. If you hold your own Bitcoin, if you have transferred your coins to a hardware wallet, where you control the private key, where no institution can lend, rehypothecate, short, or financially engineer what you hold, then the price movements caused by paper markets are interesting dinner conversation and nothing more. The price may be suppressed. Your coins are not. They exist on a blockchain that no institution controls, governed by a protocol that no regulator can alter, secured by mathematics that no court order can override. This is not rhetoric. This is cryptographic fact. Wall Street can run algorithms at 10 a.m. They can rehypothecate paper claims until the infrastructure buckles under its own leverage. They can short MicroStrategy. They can create synthetic Bitcoin supply through every derivative instrument their mathematicians can invent. None of that touches a single Satoshi in cold storage. None of it alters the 21 million coin cap. None of it changes the 10-minute settlement finality of the Bitcoin base layer. The musical chairs metaphor is real. When the paper market contracts, when leverage unwinds, when settlement is demanded, when the gap between paper claims and real coins becomes too large to paper over, the only investors not scrambling for a chair are the ones who already hold real Bitcoin in their own custody. This is the escape valve that gold never had. And it changes the calculus entirely. Gold bugs were right about the mechanism and powerless to act on it, because there was no exit from the paper system that didn't involve vaults, shipping costs, and institutional custodians. Bitcoin holders can exit the paper system completely, at any time, by simply moving coins off an exchange and into self-custody. The game is rigged. It has always been rigged, but for the first time in the history of money, there is a way out that requires nothing but a private key and the will to use it. Epilogue: the story that isn't finished. Years from now, few people will remember the specific timestamps of Bitcoin's daily drops. Few will remember the precise wording of the Terraform lawsuit or the regulatory language of SEBI's 105-page enforcement order, or the exact sequence of events that surrounded one trading firm's brief moment in the spotlight. Markets move on. Narratives shift. The next headline replaces the last, and attention is the scarcest resource in the modern world. But the structural forces this story illuminates do not disappear when the headlines change. The paper market on Bitcoin is not shrinking. It is growing. Every new ETF product, every new yield instrument, every new derivative structure layered on top of the underlying asset adds another claim to a fixed pool of real coins. The ratio that concerned Caitlin Long is not improving. It is worsening by design, because there is enormous profit in building these structures and almost no institutional incentive to constrain them. The lawsuits will reach their conclusions. Regulators will impose their orders. Jane Street will respond to every allegation in the legal forums where those responses belong. That process will take years. In the meantime, a quiet war continues. Not a war of armies, but a war of architecture. A war between the financial system that has governed human wealth for centuries, with all its instruments and algorithms and leverage, and a protocol written by an anonymous cryptographer who believed that mathematics could do what politics had failed to: create money that could not be manipulated. Bitcoin was not designed to be perfect. It was designed to be resistant. Whether it succeeds depends not on any court ruling or regulatory decision. It depends on the cumulative choices of millions of individuals who must decide whether they want exposure to Bitcoin or Bitcoin itself. The story is not finished. It is, in fact, just beginning. Outro. I hope you enjoyed this analysis. Please share it with people you care about, so that they are prepared for what is coming in the future. The forces shaping Bitcoin's price today will shape the future of money tomorrow, and the people best prepared for that future are the ones who understand the game being played right now. And before you close this episode and return to your day, I want to leave you with one question. Not a rhetorical one, but a real one that I'd ask you to sit with. If the financial system has the structural ability to create unlimited paper claims on a scarce asset, inflating its apparent supply, suppressing its price, and profiting from the gap between what ordinary investors believe they own and what they actually hold, what does that tell you about every other safe asset in your portfolio right now, and how much of what you believe you own is, in fact, just a promise? I hope you liked this analysis. Please share your comments down below, and if you found this video helpful, share it with someone who is important to you so they can benefit from this information too. And if this helped you, hit like and subscribe so I know I should keep bringing you more content like this.